You're listening to the Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from the Moose on the Loose. Yesterday, we discussed investment roadmap day number 1, how to set up ground rules, like investment rules, so you don't get lost. Because, investment is like a journey. You need an itinerary, you need a destination, so you need a roadmap. So yesterday, we talked about the guidelines for the rest of your journey. It's super important. If you do not have guidelines, well, you go here and there, you try different things, you look at past returns, and you select like strategies that worked in the past. You don't even know why or in which context. And then you just quickly jump on them thinking that it's going to recreate whatever happens in the future, and you hope to get lucky. Well, sorry to break it, but hoping is not an investing strategy. And this is why I'm offering you this roadmap. This week, actually, we're going to close this up on Monday next week. So it's going to be like a full week series on Moose on the Loose about how to build your investment roadmap. So the goal is to give you tricks, to give you guidelines, and to help you. So to give you those tools instead of telling you what to select in terms of stocks. I want you to just help you, guiding you through by you creating your own framework. You can download the actual full guide to build your roadmap at dividendstocksrock.com/roadmap. So you just put your email there. You're going to receive your the PDF document. It's a full guide going from day 1 all the way down to the end, where you have a fully built portfolio built with companies that you love and that you have a high level of conviction, because it's, again, all about investing with conviction, right? So once you have rules, that's great. But now you need to know where to go with that, right? So today is about how to use a stock screener. So of course, you need to start somewhere, and you can certainly not review 9,000 companies. And you don't want to review that many financial statements either. So you kind of need a shortcut. And of course, using a stock screener means to use a shortcut. It also means that the goal here is to narrow down your research for companies that will meet some basic criteria, like some of your non-negotiating rules. If you're looking for income, and we're going to talk about that later today, you may want to add the yield there. I would not do it, but you may want to put there. You may want to put payout ratios. You may want to put a lot of things, but we're going to talk about how to use a stock screener in the good way. There are simple rules that you can use, so your research will be more efficient, and you won't discard amazing stocks just for one bad metrics. So let's start with rule number 1. Keep it simple. Yes, the goal is to narrow down your research, but not by too much. You don't want to add too many metrics. You don't want to go fancy and complicated. First, if you go super fancy, it may be hard to have companies that meets all your criteria. Maybe some metrics will not blend so well together. So you want to have some diversification, right? So right now you're not looking to add one company, you're looking to build a portfolio, invest a lump sum amount of money, or invest your dry powder. So you do not want to end with 5 companies. You are at the beginning of the journey, and the metrics is actually just the beginning. Speaking of the beginning, at one point, you're going to pull out a stock research, and a whole sector is going to come up on top. And it's kind of normal, because whenever you look at a stock screener, there is something going on in the economy, right? And that something is helping, benefiting from some companies, and it's the opposite for others. But the point here is, and that's why we have companies labeled into sectors, is to categorize them, telling you a little bit more as an investor. Okay, so this type of business is a consumer staples. So this one will not grow super fast, but will be recession resistant. On the other side, if you're investing in an industrial company, well, those are more cyclical and they're more capital intensive. So which kind of like market event and an economic event will affect those sectors. But if at one point everybody is bullish on construction and then the construction business is running like there's no tomorrow, well, a lot of industrial stocks are going to look crazy good, and it's normal. It's like the context around that. So you don't want to have like 12 companies from the same sector either in your portfolio. So you must be aware of that. So it's normal that from time to time, you're going to pull out a stock research and then you're going to have the impression that the only good companies are in the financial sector. But that is just timely. So you have to look a little bit further than this. Talking about looking further, rule number 3, numbers out of context don't mean much. What does that mean? Well, if you're too demanding with your number, with the numbers you're looking for, with the filters that you're applying, and the number of metrics, well, you're going to discard great companies. A classic would be to discard all companies with a payout ratio above 80%. Well, did you know that for a quarter, Costco showed about a ratio about like 112%? So you would have discarded Costco because on that quarter, the company paid a huge special dividend. And if you look at the payout ratio and you just stayed with the stock screener without any context, well, it won't appear because it will not match your 80% maximum payout ratio filter. So same thing with the yield. You may be tempted to put a minimum yield of like 4%. But why would you discard a company paying like 3.5%? Is it that important, that 0.5% between 3.5 and 4? I'm not too sure. And think about that. A business that has a lower yield, most of the time it means that the business is reinvesting capital inside the business, like reinvesting capital into R&D, into marketing, into growing their sales team, or into innovations. All of those things are kind of great. So sometimes it's not the end of the world if the business does not share all the wealth with shareholders and decide to reinvest in the business to keep its competitive edge, to keep it moat, and to keep on thriving. Now, rule number 4. The goal of using a stock screener is to narrow down your research, yes, but you still want to have a few hundred stocks because you're at the beginning of your journey, you're at the beginning of this roadmap, and you want to have multiple choices. And don't worry, in tomorrow's podcast, we're going to see how you can narrow it down fairly quickly. But the first result of your stock screener should give you a few hundred stocks. The one that I'm using is roughly giving me about 400 companies, which is great because after that, I'll be able to select the cream of the crop. So that's great. So the four rules, super simple. So rule number 1, keep it simple. You don't want to add too many metrics. You don't want to go fancy. The second one is keep in mind that from time to time, a sector will like rise and shine and it will look amazing. So you have to put that into context, leading to rule number 3. Numbers without a context don't mean much. So again, that's why you don't want to go too much narrow at the first research. You want to have something a little bit more general. Rule number 4, you go general, you want to narrow down, but you still want to have a result with a few hundred stocks to dive in. So for example, my stock screener is quite simple. I use 3 metrics. A positive dividend triangle, that's it. So past 5 years, positive revenue growth, earnings per share growth, and dividend growth. And that's enough at this point. So I just put like 1 in the dividend stock screener, and I get about 400 companies. If you want an idea of what it looks like, you can download the Rockstar list, which is quite similar to this. And you can download it at moosemarkets.com/rockstars. You'll have about 300 stocks, I think. So it's a pretty good starting point. And you'll be able to follow me tomorrow, when we're going to talk about how to narrow down by sectors and like create that watch list before you get into deeper analysis. So the 4 rules, simple screener, give you about 300-400 stocks, and it's more than enough at this point. This is what you want. If you want to have the full roadmap guide. You can download it at dividendstocksrock.com/roadmap. I'm going to keep on this journey on investment roadmap day 3 tomorrow, narrowed down by sector. So stay tuned and do not forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.